When you look at a massive hydroelectric dam, it usually looks incredibly peaceful from the top, just a flat, calm lake. But down below, well, out of sight, the concrete is groaning under millions of tons of pressure.
Yeah, that is exactly what looking at the Bitcoin market feels like right now, especially for anyone holding through this latest drop.
Right. So today our mission in this deep dive is decoding the severe liquidity test that just, cracked the dam. We're talking about the drop pushing prices from over $72,000 down to a low of 69,200.
Exactly. And we're looking at the raw on-chain data, exchange flows, and corporate treasury filings to figure out exactly what's breaking beneath the surface.
Because the structural stress isn't really visible on the price chart until the crack actually forms, right?
Right. And right now, that stress is coming from a brutal combination of institutional capital fleeing, automated trading algorithms reacting to legacy supply, and, well, corporate treasuries being forced to make some very tough choices.
Let's start with that institutional flight because, the numbers in these exchange filings are just staggering. Over a single week, $1.67 billion exited exchange-traded products.
Which is the largest single-week fund outflow we've seen in 2026, by the way.
Yeah, a massive extraction of fiat liquidity. And if you're a long-term retail holder, it feels like institutional investors are just fair weather fans rushing the exits the second things get choppy.
Oh, absolutely.
But the real damage isn't just them selling, is it? It's that $766 million liquidation cascade they triggered.
Right. So to understand why that cascade happened, you really have to look at the mechanics of the derivatives market.
Mhm.
I mean, traders in that space borrow money to amplify their bets, obviously.
Right.
So when institutional players suddenly pull out $1.5 billion, the price naturally dips.
And that dip triggers a mechanical reaction.
Exactly. The exchanges automatically sell off those leveraged traders' assets to cover their loans.
Yeah.
And that forced selling pushes the price down even further, triggering, more forced selling.
A domino effect.
Yeah, a total domino effect. The algorithms running those risk engines, they don't care that retail sentiment remains overwhelmingly optimistic. They just blindly execute liquidations. It's purely mechanical.
Wow. And just as that algorithmic selling is shaking out the market, a massive ghost from the past decides to wing up.
Oh, yeah. The Mt. Gox supply.
Exactly. 10,306 Bitcoin, which is worth roughly $730 million, just moved from the Mt. Gox estate's deep cold storage into hot wallets.
Right ahead of their October 2026 creditor distribution.
But wait, I have to push back here for a second. Those coins just moved from one wallet to another. No one actually clicked sell, right? Are trading desks really panicking over a simple internal transfer from a defunct exchange?
Well, you'd think they wouldn't, but in a market where liquidity is already spread this thin, trading algorithms aren't waiting around to see if a sale actually happens.
They just assume the worst.
Pretty much. The second those coins hit a hot wallet, which, is connected to the internet and ready to trade 24/7, the bots instantly price in the threat of a massive dump.
Oh, wow.
So the algorithms preemptively adjust their risk models, which directly accelerated that drop below 70,000. They price in the fear before a single coin even hits the order book.
That is wild. So if algorithms are preemptively pricing in fear and shaking out the derivatives market, who is actually on the other side buying?
That is the interesting part.
Because when you dig into the filings from publicly traded companies, they're splitting into two totally different camps to navigate this volatility. You've got Strive going on the offensive, right? Expanding their equity issuance by $4.2 billion to buy 19,000 Bitcoin.
Yeah, incredibly aggressive move.
And then you have Hyperscale Data, who halted their at-the-market equity program entirely. They're holding steady at around 704 coins just to preserve capital.
It really comes down to two totally different philosophies on treasury management. Strive is deliberately diluting their own company's shares to raise cash.
Just to absorb the supply institutions are dumping.
Exactly. They are betting that accumulating right now will pay off massively in the long run. Hyperscale, on the other hand, is slamming on the brakes. By halting their equity issuance, they stop diluting their shareholders.
Right. It's like two entirely different survival tactics in a blizzard. Strive is basically running out to aggressively hunt using leverage, selling pieces of their own company equity to buy up discarded supplies.
Yeah, banking on the storm clearing. While Hyperscale is prioritizing the financial health of their core business operations over aggressive asset acquisition, They are just rationing supplies and boarding up the bunker.
Which is exactly why simply checking the price ticker isn't enough to survive this kind of volatility. You have to watch the underlying mechanical flows.
The institutional flight, how algorithms react to wallet movements, and how corporate treasuries leverage their stock to absorb the shock. That's the real story.
Right. Which leaves us with a pretty wild scenario to think about. If aggressive accumulators like Strive successfully swallow up all the supply that these panic institutions are dumping right now, will a handful of corporate treasuries eventually dictate market liquidity more than retail investors ever could?
That is a big question.
Yeah, we might be watching the water pressure shift from the open lake into a few massive private reservoirs, something for you to ponder.